Okay, I'm starting now, and there is a question about a dual currency bond. So a dual currency bond uh, pays coupon interest in a currency other than the currency that pays for the principal. That means a dual currency bond will have two kind of different currencies. Principal and interest are paid with different currencies. So that when a bond that is paid with two different currencies, one currency for principal and the other one for another one for interest coupon, we call is the dual currency bond. Okay, and the second question is about a bond's uh, indenture. So what is a bond indenture? So a bond indenture actually is a contract between borrower and the bondholder. So in the US and in Canada, a bond's indenture is called in the US and in Canada, a contract between a borrower and the bondholder called bond indenture. So bond indenture is actually is a covenant is a covenant, and a covenant includes a negative covenant and also affirmative covenants as well. So negative covenant is mean something that borrowers must not do. For example, cannot issue more bonds just based on the current asset. Okay, and affirmative covenant is that the borrower have to must do. For example, I have to pay the coupon on time to the bondholders, and also need to kind of give a very correct information, like even operation of the company to the bondholders, so it's some basic information about a bond indenture. Okay, it's kind of very difficult to understand about this one. Even when I read it on the book, it's still very difficult to understand that, because for example like this, but and I also need to add on some information on the affirmative covenant is uh, uh, we not the borrower is not just pay the interest on time to the bondholders, but also need to pay the principal on time to the holder as well. And besides that, the borrower also need to buy insurance for the assets, to protect these kind of assets, etc. There's a lot of terms on this kind of in this kind of like covenant. So yes. And next question is a little bit difficult because I need to read the book again, because it's very difficult to understand this one, because I have studied these subjects for maybe 2 weeks ago, and I did not remember all the details of the subjects. So I think I need to read it again to make sure that I can understand the question. Actually the question is very simple. It's about very simple. It's a very basic knowledge of the subject. But because I forgot it, I did not remember the detail of the subject, so I need to read it again. So the question for this one is, an investor buys a pure discount bond, holds it to maturity, and receives its par value. For tax purposes, the increase in the bond's value is most likely to be treated as A, capital gain, B, interest income, and C, tax exempt income. So for this one, okay, because I just read again the subjects, so I just want to express my understanding about this question, for like, because this question is mentioned about a pure discount. A pure discount, I think is actually a zero coupon bond. That means no coupon will be paid during the maturity. So that means a pure coupon bond, that means you buy it at $100, with present value is $100, and for 10 years, and during 10 years there are no coupon for you. They do not pay any coupon for you. But at maturity, the bond, the issuer will pay you 120. So that means you can get the 20 difference between the present value when the price you buy it, but there was no coupon bond, and you actually gain $20. But we know that for the interest, interest coupon will suffer for the ordinary income tax. It will just remember, for the interest coupon will subject or suffer the ordinary income tax, and the capital gain will subject the capital gain income tax. So, and just remember that capital gain income tax will lower than ordinary interest, income tax. So if for this one, because we see that for pure discount bond there are no coupon is paid during the maturity. So that means, okay, so basically we can see that, oh, this one no interest coupon, so of course this one like $20 different will be twisted as the capital gain. But no, if we treat this $20 difference as a capital gain, and will subject with the capital gain income tax, is not fair for the people, because the people will buy this kind of bond to not have to subject to the ordinary income tax. So for this one, we still treat this $20 gain as need to treat as an interest tax, or we can call it ordinary income tax. So we will choose the answer B, interest income, not capital gain. Capital gain is not fair for the people, because if we treat $20 gains as a capital gain, because capital gain will subject the lower tax than the interest gain, okay, interest income. Okay, we come to reading 42.2, and the question that a 10-year bond pays no interest for 3 years, then pays 2,900, followed by payments of 35 semi-annually for 7 years, and an additional 10,000 at maturity. So this bond is first zero coupon bond, or step up coupon bond, or deferred coupon bond. So for this one, we need to analyze the question, and first of all we need to understand what is zero coupon bond and what is step up coupon bond and what is deferred coupon bond. Okay, so the easiest one is zero coupon bond. So zero coupon bond is the bond pay no coupon during the maturity to the bond holder. So is this clear? Everyone understand about this one? I think when people like study to this subject, fixed income, is we all understand about the zero coupon bond. No coupon will be paid during the maturity, during the period of the bond, during time life of the bond, during time life of the bond. And we come to the next one. The answer B is the step up bond, step up coupon bond. What is step up coupon bond? Just one note we need to remember, that a step up coupon bond most likely happened when there embedded option there. I mean, sorry, not embedded, it's callable feature on that bond. So if a bond have a call feature, that means this bond have a chance to have the step up coupon. That means the investor, the bond issuer might pay the coupons, might pay the coupons like more than usually the issuer have to pay. That means like, okay, we take an example of a bond for 10 years maturity, and now at year 5 the company are doing well about their operation, about business, and they got a lot of cash, a lot of money, and the company decided to pay the interest much higher than before. Like maybe before, each year the bondholders only get like $50 per year for the interest coupon, but now the company get much cash from their operation, so they decided to pay $100 for interest coupon. So that means it will see the maturity shorter, maybe for 8 years only. So that so for this one we call step up coupon bond, because the issuer can pay higher interest, higher coupon to the investor. So one day they will like implement the callable feature for this bond. So we call this one a step up coupon bond. And the last one is about deferred coupon bond. What is deferred coupon bond? Deferred coupon bond, that is a bond that the issuer will not pay any coupon for, especially for the beginning of the period. For example, if a bond have maturity for 10 years, and for the first 3 years the bond issuer does not pay any interest to the bondholder. Yes, and then they will pay interest pay coupon to the investor started from year 4 forward, on moving forward. So this one we called deferred coupon bond. But there are some notes we need to remember about deferred coupon bond. The first one we need to remember that this kind of bond is suitable for some kind of very typical business. For example, if you a company, like construction company, they build some buildings, and first of all they need to like rent out the buildings to the customer, and they need because they need to build it, and normally a building need to build properly, maybe 2 or 3 or 4, even 4 years. And then we also need time to sell out or to rent out the building to customers. So it probably take 3 or 4 years to get the cash flow for this kind of business. So for this one, company will typically offers a deferred coupon bond, maybe 3 or 4 years. I mean, to wait until they actually can make money, can get the cash from the customers, you know. And one more thing we need to remember about this kind of deferred coupon bond is normally we can, like, zero coupon bond can twist it at a deferred coupon bond. Yes, it's kind of very typical one, very unique one. And one more thing we need to remember about deferred coupon bond is they get a privilege from interest coupon tax as well, because like for the first 3 years you do not get any payment from interest, so you do not have to pay for the tax. So I think it's get some privilege on that one. And so in this book they also say that tax advantage for bondholders, but in some countries, not all countries, I think so. It's because it's kind of like it will twist it as capital gain, where par minus P it twisted as capital gain. For this one I do not understand much why they treat this one as a capital gain, but I will explain more, or maybe study more about this one. Okay, there are 2 questions left, so I will finish it and have lunch, because it's 2 p.m. but I had breakfast, was a little bit late, so I'm not so hungry much. So for this one, okay, the next question, I try to finish these 2 questions in maybe 3 or 4 minutes. Okay, the first one is, which of the following statements is most accurate with regard to floating rate issues that have caps and floors? So first of all, we need to talk about what is floating note rate. So floating note rate is also called as a floater. So floater will be calculated. Floater is the way we calculate coupon rates equal to reference rates plus with the margin. So margin is fixed. Okay, so coupon rate in this case will depend on the reference rate. So if reference rates increase, so the coupon rate will increase, and if reference rate decrease, so of course coupon rate will decrease, because it's the component between two factors is a coupon is a reference rate and the margin. So margin is fixed. Okay, so coupon and reference rate is changeable, or even variable. Okay, so the next one is cap. What is cap? Cap is a maximum coupon rate that the issuer will pay to the investor. For this one is protect the issuer, because it doesn't matter how many percentage that LIBOR, reference rate is, but it will not be higher than this one, even because this one have cap. So for this one, flowing note rate, we use reference rate. Normally we will use LIBOR rate. Okay. For the next one, we talk about the floor. The floor is the minimum coupon rate that the issuer have to pay for the investors. So this one will protect the investor. It doesn't matter the reference rate deeply decrease, but the issuer still need to pay at least coupon rate to how many percent. For example, like at least the issuer have to pay for 5% coupon rate to the investor. It doesn't matter how deep LIBOR rates sinking. For example, like, because we know coupon rate will be equal with the reference rate plus with margin. So margin will be maybe 2%, and now the coupon rate will depend on the reference rate. So normally we will use LIBOR rate as a reference rate. So for this month, the reference rate will be just 2%, so very low. And now coupon rate is only 4%, because 2% on the reference rate plus with 2% in margin, so only 4%. So the floor said that the issuer have to pay minimum 5% for coupon rate to the investor. So this one is protect for the bondholder. Okay, we all understand about the cap and the floor. Okay, the next question, and also the last question is, which of the following most accurately describes the maximum price for a currently, I like to say currently, because for this one it's easy for me to wrongly pronounce this word, so I prefer to use currently or currently callable bond. So callable bond will be called at a call price, of course, not gonna the same with par price. If we're the same with par price, no bondholder will agree with this one. Okay, so for this one, it's call price. Okay, it's nearly 6 minutes. Bye. Okay, so let's start it for the next question on the reading 43 about security, about fixed income, funding, insurance, and reading the 43, there are some questions. The first one, the question about this one, with an analyst who describes a fixed income security as being a structured finance instrument is classifying the security by A. Credit quality, B. Type of issuer, C. Taxable status. So to answer this question, we need to understand about the question first, because the analyst is using a technique called structured finance instrument to classify the fixed income of this company. So there are three answers on these questions: A. Credit quality, B. Type of issuer, and C. Taxable status. And based on the question, this analyst use structured finance instrument. So that means they use, because with structured finance instrument, we can understand about like how many percent debt of the company above over the capital of the company, and how is it EBITDA above the interest expense. So this one, interest coverage. So we also think about FFO of the company is a fund free cash, a fund FFO is fund free cash from operation. That means like it will equal with net income plus with NCC. I mean also can go net income plus with working capital. That means how much money the company can get after the business. So we need to see about the structure, finance structure of the company. So like if the debt above the capital is too high, so this company of course will belong to maybe triple B, is not A, or BB plus, is kind of like that. So we have credit, so this one belongs to credit quality. So based on the lesson, we have the credit quality, we have Standard Poor's, S&P, and Moody and Fitch all provide credit ratings on bonds. So for example, AAA, BBB, CCC, like the highest one is AAA, then AA, and then A, and the next one will BBB, BB, and B, and lower than B will be kind of a young bond. So we shouldn't invest in a young bond if you do not believe on your like prediction ability on that bond. Okay, so and the next one, the reason why we choose credit quality, okay, because the structure, because struct finance instruction that the analyst used, and it's not type of issuer, because type of issuer will be there are some kind of type of issuers, like it's a non-financial organization, is a bond belong to non-financial organization or not, or is a government bond, or is a corporate bond, or is a minus bond. So there are so many kind of issuer. So this one is not based on type of issuer to classify the bond. And the third one, we talk about the third one here is taxable status. It's not taxable status, because based on the textbook said taxable status in various countries, some issuers may issue bonds that are exempt from income taxes. exempt from income taxes. So there are some kind of bonds. There are some kind of bonds that they don't have to pay for the they don't have to pay for the tax income. They don't income tax. It's kind of like, I think investors, they do not have to pay for the income tax, but for some kind of bonds, especially, for example, in the United States, these bonds can be issued by municipalities, and I'll call municipal bonds or minis. It's very difficult to pronounce this one. Okay, now we can know that why this one we choose. The answer is credit quality over the type of issuers, over the taxable status, not these two. Okay, but before besides these three kind of classifications, we also have some others classification to distinguish the bonds. For example, like coupon structure, or we also and the next one will be geography as well, and it is also about currency as well. There are so many ways to classify the bond. Okay, the next question is very easy, but it's kind of very difficult as well, because the question is very short, but we need to remember all the knowledge of this question. LIBOR rates are determined: A, by country's central banks; B, by money market regulators; C, in the interbank lending market. So for this one, LIBOR rates are determined because we know that like LIBOR is the rates that will be calculated on the average of 18 banks in 18 bank, I don't know, 18 bank survey of 18 banks, I don't know, is it belong into your UK or like in the world, but it's said that it will get the average of the rate of 18 banks, and we need to eliminate the highest and the lowest rates from these banks, because if a highest and lowest rate from this bank still be calculated, it will be a huge change on the LIBOR, because these rates have a very weighted on the 18 on the portfolio on this. So we need to eliminate the highest and the lowest, highest and the lowest. Okay, highest and lowest quotes. Because for example, a Vietinbank quote the rate for saving today is 6%, and Sacombank, for example, quoted the saving rate today is 9%, for example. Okay, and there are another bank quoted with 12%. So that, for example, like this, we need to eliminate the highest one and the lowest quote as well, to make sure that these kind of quotes are not weighted too much on the portfolio. So I think for LIBOR is depend on, so based on the question, so LIBOR rates are determined by countries' central banks. I don't know if this one, but maybe later we can check it out and check it out the answer at the end of the book. But now I do not want to check it out now, because I just want to do it by myself first, and then if I'm wrong on this one, we're gonna fix it later. Okay, next question. This is question number 3. Like, in which type of primary market transaction does an investment bank sell bonds on a commission bonds? That means like an investment bank sell bonds to a company to get commission by which way of transaction. So first of all, we need to understand about the question first. There's keywords on the question we need to understand. Is primary market. Okay, primary market, we all know that primary market, what is that? That means the company just sells the first time bond to the market, so we call primary market. It's not secondary market. Okay, secondary market means that after the company sells the bond to the market, to the investors, and these investors sell the bonds to another investors, so that one called secondary market. But for the company sell, the first time company sell the bonds to investor, we call primary market. And we also know that if now this year the company will issue 1,000 bonds to the market, maybe 2 or 3, 5 years later, the company will issue 1,000 bonds to the market. So we don't call that is primary market. We still call, I think we still call that a primary market. I think so. I think I need to check it later. Okay, so on primary, market, we have public offering, and we also have private placement. Public offering is the bonds will be sold to a public, and private placement, that means the bonds only sell for some kind of selected organization that qualified to buy the bond. For example, some kind of institutions, not people like us. Okay, so in public offering, we have some kind of transaction to sell the bonds to the public. First of all, we have auction. Auction means who bid the price highest will get that price. I don't know I understand that is correctly or not, but just take one example, like a company with a very high credit quality, they issue bonds, and a lot of people, they want to have the bonds of this company, so a lot of people want to buy it. And because the demand and supplier have a big gap, so the company decided to raise the price of the bonds. I think that it auction, but I also need to check it out again later. to make sure that I understand this knowledge. And the second transaction we have is self-registration. Self-registration. Registration. Very difficult to pronounce this one. The second transaction is self-registration. Okay, so this one we just take about like a company, they want to issue 1,000 bonds. 1,000 bonds, but they said this year they will issue 500 bonds, and after 5 years they will issue 300 bonds, but they don't need to get a approval from the SDC or from the government, because they already get approval from the first time. The government approved for issuing 1,000 bonds already, but the company does not want to issue one time. They want to issue several times. So we call this one is self-registration. Very difficult to pronounce this one. And for this one, actually, it's not every companies can get this kind of privilege. Just some company, I think just some very famous company or very high credit quality companies are granted this position, I think. Okay, the third transaction we have is underwritten offering. Underwritten offering, that means the information price is public to people in public, and based on dealers, based on people who are interested in the bonds of the company. Okay, so and there's this one, pricing. We have, like we just talk about the dealer's interest. The price is based on dealer's interest decided price. And for example, trading prior to offering. So for example, like, because you don't know how to decide the price of the bond, so you just call the customer randomly and said, oh, blah 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 blah. Are you interested in this one? Something like that. And people, no, I'm not interested in this. But a lot of people say, oh yes, please give me some more information about that one. So based on the interest of the dealers, of the investors, we can decide the price. For example, even we are about to sell something, but we don't know how to decide the price of that one. We just go to random people that we are about to sell this one. Do you want to deposit 10 million VND to get this one first? No, I'm not interested in. So just kind of like that. Okay, so this one we call underwritten offering. And in this case, maybe just a investment bank will buy all the bonds of the company and then will sell it to the dealers, and dealers will sell it to investors. And this one just and also the investment banks also get some commission from selling this, but they have to buy all the bonds of the company. And the last transaction is about how it's called best effort offering. That means, okay, I will try my best to sell the bonds for you, and the more I sell, the more bonds I sell, the more commission I get. So for this one is you can sell, but you don't need to buy it all the bonds from the company. So, okay, so we understand about this one. So for this question, I think which type of primary market transaction does an investment bank sell bonds on a commission basis is best efforts offering. Okay, there are 3 questions left, but I think I will just like rewind a little bit about my knowledge on these kind of questions. And the first one is secondary market bonds transactions take place. This one is very simple because secondary market bonds transaction take place in a dealer market. So this one is easy because dealer will ask for a ask price and expect to get the best bid price. So a secondary market transaction take place in dealer markets. And the next question is sovereign bonds are described as on the run when they are most recently issued. For example, like on the run. So sovereign bonds is called on the run. On the run is for example, if a bond issue in 2018 and have the maturity for 10 years, and because this one just recently issued, so we called this kind of bond as on the run. Okay, so it's kind of easy, but we also need to talk a little bit about some kind of let's say kind of issuers in corporation. What should I call this one? I think I need to take some notes on this one. Okay, this one I think okay, so we have sovereign bond. Sovereign bonds, a sovereign bond is bond that a government issue to the people. That government issue to the people by that company currency, and also can issue the bond. The government also can issue by another another currency. For example, like Vietnam can issue the bond with the Vietnamese Vietnam dong, and also can issue bond with the US dollar. But there are some kind of risk for the people who invested in the bond with the currency in US dollar. For example, like if you invested in Vietnam dong, if they lack of money to pay for you, they can print the money and pay it for you. Because we ignore the inflation here, okay? We ignore inflation here. So if a person who invested in sovereign bonds issuing by US dollar will be at risk, because it's not the government, Vietnam government cannot issue US dollar in Vietnam. Okay. So we talk a little bit about the on the run bond, or on the run issues. That means most recently issued bonds, like just the bonds just issued 2 or 3 years ago. So we call on the run bonds. Okay, now we talk about non-sovereign bonds, non-sovereign bonds or non-sovereign organ governments. We have some kind of government entities, not national government, is just like state government only. So we have a state, city, or province. So we have some kind of like the bonds from non-sovereign. This one, when, for example, in Hanoi or Ho Chi Minh cities issues bonds to the people, so we called this kind of bond like a non-sovereign bonds, because it is issued by non-national government. It's still issued by government, but it's not national government. It's issued by state, issued by the cities, issued by the provinces. Okay, so this one we called non-sovereign bonds. Okay, the next one we will talk about quasi government entities. Quasi government entities, that mean we also can call that is agency bond. Okay, it's actually quasi government bond is agency bonds, but it's backed up by government for some special purpose. Because of some special purpose, if anyone who watched the movie named The Big Short, The Big Short, you will know some kind of name on that movie. Is like Fanny Mai, Jeannie Mai, Fanny Mai, Jeannie Mai. This kind of like is called quasi, but it's backed up by government to some special like financial purpose maybe. Okay, but it's not these kind of bonds. For example, Freddie Mae issues a bond, and because people not know that this kind of institution is backed up by the government, so the price of bond is quite like, the credit quality is quite high, but actually the the default or whatever is not directly obligation to the government or the central bank, but somehow to save the economy of the country, the government will take one hand to save this kind of institution. I just know a little bit about this one, but I think I need to check it out more about this kind of quasi-gov entities. Oh, the next one we have supranational and supranational entities. Supranational entities mean supranational entities. That mean organization active globally for like World Bank, EMS, this kind of organization. So we called supranational bonds entities as well. Maturity. So maturity, we have limited 1 days to 30 years or 100 years as well. A lot. So we need to talk about more about this one.